Welcome back, everyone, to Morning Line on this Tuesday. Dr. Friday's with us. We're talking taxes, taking your phone calls, 737-7587 if you want to jump in. A couple lines open. And I was real quick before we get back to the lines. I think it was last week, there was a lucky person in Antioch who purchased from a convenience store the winning lottery ticket, I think for $110 million. There's something along those lines. I don't know that did she ever come forward? Did he come forward? I think it's been claimed.
Okay.
Maybe not. Okay. But when they do, you take that lottery ticket down to the national office, they process it, yep, you won 110 mil. The tax guy swoops right in?
They're going to step right in and take at least 40%.
Before you even get the money, the state handles that for you. They have to take it out ahead of time.
Yeah,
just like you're gambling in Vegas.
The revenue officer is actually standing there at the time.
Literally.
They send someone from the IRS. I don't know if it's true. I've never been there, but I'm told literally the revenue officer is standing there. So when the money is issued, there's two checks, and that's assuming that they're taking the full payout. They can do it over an annuity situation where they can take so much a month.
Right.
But in that case, they set up the automatic payment to the IRS based on the thing, and that may be a smarter move. I was
going to ask just on that, and we'll get back to the lines. If you win one of those massive jackpots, and you're kind of ambivalent, I can take a lump sum or I can take it over 20 years. Which one's better tax-wise?
Well, obviously, the 20 years, and most likely it'd be
probably
better
pay
because
less.
That way you pay less because you're not going to be kicked into that highest tax bracket immediately, where you're going to lose all 40. You may only be in the 15 or 25. It's only 100 or 200,000 a year, I think, over the period. I don't know on that.
Well, now if it's one of those mega jackpots where it's like $5 million a year, then it doesn't matter.
The bite and go for it.
Just take the whole big chunk.
Yeah, because then you have better control, right? You can invest that money, which unfortunately, within 5 years, most of them lose it all.
Yeah, no, I've heard that. That's unbelievable. 110 million.
I'll be more than glad to be your financial planner.
How much is he taking home if you won 110 million?
Well, about 40% less.
Okay, it's about 70, something like that. All right, which is still pretty good. Let's get back to the phone lines, and next up is Anita. Anita, good morning.
Good morning.
Hi, Anita. How can we help you?
Yes, please.
Sure.
I was calling because we had filed taxes back in 2001, 2002, and 2003.
Okay.
And looking back, I had realized that 2001 had not been filed by the same auditor that I had sent all 3 years to. Mm-hmm. However, I caught it back in 2008, 2009, something like that, and filed it.
Good.
And then they told me since it was over a 3-year period that I had to appeal it, which I did. And they still came back and said that I was no longer available for it because it had not been filed and the appeal time had passed by.
Right.
So now the IRS is sitting with $4,700 of earned money that we were due back, and there's no way for us to get it because our CPA either didn't put it in, or I didn't catch it, and therefore it wasn't filed.
Interesting.
So I'm wondering how I go about getting the money back that we paid in that is due back to us.
Can't. I'll be honest with you, you can't. You only have the law basically says you have 3 years to collect your refunds. So the fact that she missed that, maybe she filed those 3 years together, or the CPA, maybe she filed it on time or thought she filed it on time and her accountant didn't, whatever. And the IRS is renowned for not actually waiting the 3 years before they request the documents. They're not stupid. Why should I ask you before? I have to give you your money back, So, and then you can amend. So in all honesty, in this case, you might as well just assume that money. I mean, it's hard, but you might as well just assume that money is gone. You're never going to see it. There's no opinion.
Can she sue her tax preparer?
She could try to claim. I mean, if he's got E&O insurance or errors and omission insurance, and she could prove.
He messed up. It wasn't her fault.
But 10 years, 12, 14 years ago, it's going to be really hard to prove if he's still in practice. Even depending on his age, but it'd be hard to prove. And at this point, probably too late to even take a case to their insurance company. Because,
okay, that's right. She did say it was going back to 2001 or something.
Yeah. So sorry.
Well, apologize for that. Wish we could be of more help, but that's the law and the way it's set up with the IRS.
Yep.
Important. All right, let's go next to Fran. Fran, good morning.
Good morning. How you doing today?
Good. Hi, Fran.
I was wondering if the lady could tell me how much what the tax would be on $4,000.
Okay. Can I ask you, Fran, is that the only income that you have is $4,000? That's taxable?
I'm on Social Security. Well, I was on disability Social Security, and then when I became of age, I just went on Social Security.
Okay. So you have Social Security plus you have a $4,000 either distribution or income of some sort, right?
Yes.
Okay. there's going to be zero tax on that, because even if you're single, you can earn up to $10,000 and pay zero in taxes between the standard deduction and the exemption. And then your Social Security won't kick in because it's not enough money to be taxed. So she'll have a zero. You can earn up to $10,000 and not pay any taxes if you're single.
Okay, well, I'm not employed. I'm just joined Social Security, and I was in a lawsuit.
Okay,
so it's a one-time $4,000 award.
Won't make a difference.
No, yeah, you don't have to pay taxes on it, right?
You won't even have to file taxes on that because your income is too low to require you to file. The only way would be a 1099. If it comes on a 1099 is if you're self-employed, like a 1099 miscellaneous, then there could be self-employment tax on that, but that does not sound like the case. This sounds like a court, you won a case somewhere, sort of like our earlier caller, and you were awarded $4,000. You do not need to.
I mean, I was told that I had to file income tax.
You will not have to file income. They probably told everybody that because the standard would be you have to pay that on your tax return. In your particular tax return, if it's just Social Security and that $4,000, you do not need to file taxes.
Oh, all right then.
Okay.
Good, friend. Isn't that nice?
You get to keep all $4,000 in your little pocket.
You get to keep it all, and you're obeying the law.
Oh, all right then. Well, thank you very much.
You betcha. Thank you. That is the kind of call I really like.
Those,
I like all these calls, but I mean,
it's always nice to give people good news.
I see her sitting there. You know, here's a woman on Social Security, fixed income. She gets this $4,000, which is
do
nice.
Anything until I know how much the taxes
and she's a little worried
right?
about that, and I'm glad she doesn't have to worry about that anymore.
All $4,000, she can.
Good for you,
make
friend.
her life a little better.
Exactly. Enjoy that. Let's go next to Ricky. Hi, Ricky.
Hi, Nick.
Good morning to you, sir. What's on your mind?
I'd like to know if you have to pay taxes on a estate sale if the sale of the property is not is actually less than what the appraisal price is.
Answer is no. You might want to file taxes on it because you might want to carry that loss forward so you can offset other income later. But the fact is, if the estate was worth $500,000 and you sold it off for $400,000, then there's no taxes due because obviously you didn't sell it for the appraised value, and only what was above the appraised value would be taxable. So no.
All right, I appreciate it.
Really quick, he can hang up on that one. But just a quick note: there has been some changes in making sure if you're the person over an estate, maybe your parents have passed away or whatever, you do want to make sure you're getting appraisals. The IRS will require those to make sure that the step up in basis is followed. Because a lot of times what happens is someone passes away, they leave their home, some stock or whatever, and a lot of times people are taking. Well, the house next door sold for $200,000 right around the time of Mom's death, so that's what we're going to use as our cost basis.
Yeah.
The government's not accepting that. They want a physical appraisal done on the property and on the contents inside. There could be antiques in there, whatever. They don't know, and so a lot of times that money kind of gets lost within an estate. So they want, if you get, they may call it in and they may require these, or you can end up with a zero cost basis because they will disallow all cost and you'll end up paying tax on everything for the estate.
Something to consider, Ricky. Yeah, thanks for mentioning that. Listen, let's take a break on that note. When we come back, our final segment with Dr. Friday, Michelle, Margie, others, stay there. We've got some lines open, but we'll get to those calls until the 9 o'clock hour right after this. Stay with us.